Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, December 4th, 2019. And in this video, I want to go over precious metals, gold, silver. We're mainly focus on gold and the gold mining stocks here, and also the US dollar. As I often say, my opinion, any analysis on gold is incomplete without also taking a look at where the dollar's heading. Ideally, you want to align or confirm your analysis on gold with the US dollar. I'll get to that in a second as to why that is. And as far as the gold mining stocks, what prompted me to do this video, I constantly keep an eye on gold. I'm always watching, and there are times, if you've been a member of the site for a while, you'll know that day after day throughout the I'm posting constant updates, trade ideas, analysis on gold when it's tradable. And then for weeks I may step back, and if I have a request, I'll post something. And I'm like that with pretty much any security or sector. I'll move on to the next one, and because things trend and then they don't trend, and that's the key. And you can't really make money, or it's very difficult to make money when anything's consolidating, is in a choppy kind of directionless trend, and that has been the case with gold lately in the precious metals. So I just want you to know that I keep an eye on them, but I'll certainly pick up my post trade ideas in the sector analysis if and when it looks like we're going to start trending again. But with that being said, there's always interest, and there was quite a few questions and buzz in the trading room lately on some gold mining stocks. I'm going to start there, and again, I just from time to time I like to do an update here. So let's dive into the charts. Now this is the Amex Gold Bug Index. This will look, you could overlay GDX. Now this is an actual index, so I can go back farther in time. You see, we're going all the way back to the late 90s here to the left of the chart. This is a monthly chart actually. Each candlestick's a monthly candle, and so these are your cyclical bull and bear markets that we've had. Gold stocks bottomed back in 2001. We had a bull market. We had a bear market. And again, it might not look like much on this chart, but that's a big drop right there. That's the meltdown in the financial crisis in 2008. Yeah, that's a 71% drop. So might look like a little correction or blip on here, but most certainly a bear market. Then a bull market. Bear market, which ended in the miners back in late 2015, early 2016. And it's been in a bull market since, but sort of a kind of a slow grind. And again, this is Huey. But what I wanted to show you here are a couple things. You can see trend lines, indicators. Let's turn all of that off, and let's turn all those lines off, and just simply take a look at a comparison. Let me move this down. No, I don't want to cancel. I don't want to delete all my drawings on that chart. Got a lot of drawings there. I wanted to click right here and take a comparison of gold. And so what I wanted to show you is, again, this is the Huey Gold Bugs Index. This is a gold mining stock index. And you can see unmistakable positive correlation, a tight and direct positive correlation. Yes, if I zoom down to shorter term time frames, again, these are monthly candlesticks and going back decades, and there are periods where gold may go up for a couple days or a couple weeks, and the miners don't go up, or they actually go down. And those are usually trading opportunities where you get a reversion to the mean. But when you look at comparisons, when you're trying to see how correlated different assets are, you don't look at the difference in price here. You look at the trend, because they're priced on a different scale. I have gold right here in the yellow line, the Hueys and the candlesticks here, and you can clearly see that they move up and down in almost perfect synchronicity. That's unarguable right here. Again, it doesn't look like much because the scaling on the price is different, but this trend, all these trends in the inflection points when they turn are the same. So with that being said, there is the relationship, the correlation between gold and the gold mining stocks. Where I'm going with this is, I had some questions in the trading room yesterday, and I'll get to that. I don't need to know. I can spend all day long analyzing GDX, but and I even made this point. It looks like it could break out. Might have broken out recently, but it's only going to go so far without the metal confirming. This, I promise you, GDX will never embark on a bull market, a substantial bull trend, 20, 30, 40, 50% gain without gold going up. If gold goes down or stays flat, you're not going to have a bull market. And likewise, same thing with a bear market. So, my primary concern, any breakout I see on the miners, I want to see it confirmed with a breakout in gold. Otherwise, that breakout in GDX is likely to fail. So let's flip over to gold here real quick. There's a long-term chart. Again, we'll go back to, let's say, this is when gold started trading back in 04, 05, and I'll show you one other comparison. So when I get to the charts, you'll understand why I'm going to analyze the U.S. dollar and the euro in this. So we go to Edit Chart Properties. Let's just overlay. We'll do UUP, which is the U.S. dollar index. Now you might say, that's weird. It's hard to tell. What we'll do here, since there's an inverse relationship. Remember, gold and GDX have a positive correlation, and gold and the US dollar have an inverse correlation. I mean, one's go up, the other goes down. So what we can do here is simply take UDN, which is the bearish. We're turning the dollar upside down, and then you can see that relationship a lot better, because this makes it into a positive correlation, because again, it's a inverse of the dollar. And again, don't pay any attention to the price differentials. Look at the trend. Gold up. Remember, gold's on the candlesticks. This is the inverse dollar ETN, and you can see a very clear. Sometimes there's a brief disconnect, but overall, gold peaked right here. See on the candlesticks, and there's the yellow line where the dollar bottomed. Remember, in UDN, the inverse dollar, it's going to show you a peak. And from there, obviously, they both fell, and this is where we had a major bottom in the dollar, or top, I should say, although it's still, the dollar's still moving higher, but you can see the correlation there. And again, there's been a little bit of a disconnect from time to time, but for the most part, the trend's intact. Okay, so now we've got the correlations out of the way. Let's look at the charts. Okay, what I've done, I've jumped down to a weekly chart of gold. We'll go back here. We don't need to go back very far. This, just to kind of get a bigger picture on a weekly chart, just going back over a decade here. There's a bull market all the way up to the highs in 2011. That's when gold peaked. Bear market, gold bottomed here in late 2015, and we've been in a bull market since. You can look at another way. These are the primary trends, and an uptrend is simply a security making a series of lower highs, or lower lows. Nope, backwards. I'm saying it wrong. Higher lows and higher highs. It's that simple. And then a downtrend is a security making a series of lower highs and lower lows right there. So that was the point right there where we peaked in gold, and then a series of lower highs and lower lows until that bear market was over. And now again, since 2015. You can see we're clearly in an uptrend, clearly in a bull market. Obviously, this bull market doesn't have the vigor that this one had back here, but it is a slow, steady grind upward so far. Let's turn those lines back on. And so what stands out is we had this primary downtrend line here. It was broken out, back tested. That was bullish. And I guess to just keep it simple in a nutshell, by nearly all metrics I'm looking at on this chart and other ones, gold is still in a bull market, just like the stock market is. I have my thoughts on where the stock market's going. I have my thoughts on where gold's going, but that may or may not prove to be the case. But as of now, I think it would be hard for anybody to argue that the bull market in gold is over. You can't, certainly we made a higher high. In fact, when would it start to be called into question? Well, we have a major reaction low right here. That was our last reaction low on the weekly chart. We have another one right there. So if we took out that low, that reaction low, we took out that one, and I think big level here is 130. That was a big level for me on gold when it was taken out. Even before it was taken out, we broke out with an impulsive candle. So we could come in and back test that, and that would be nothing but a healthy back test and a good buying opportunity for gold, or at least an objective entry. I should be careful with my words. Only hindsight will tell if it proves to be a good buying opportunity. It could be a horrible buying opportunity, but the thing is, it's objective. It's a big level. I don't know if we'll get there. I don't think we'll get that low, but it's possible. And if we do, you will certainly see some analysis coming out from me highlighting that 130 level. I'll look at the charts at the time. What do the daily charts, the weekly charts, the 60-minute charts look like? What does the dollar look like? And then I'll determine if I want to buy there, and if so, how aggressive do I want to buy? Maybe just scale and keep it light, and other things. And maybe if we get down there, let's just draw a scenario here. There's a potential uptrend line. There's only a couple reactions so far. So let's just say for right now, and keep it simple, this would be my most bearish of my bullish scenarios, if that makes sense to you. That would be a drop of about, from where we're at right now, if we worked our way down there, it would be nice because you'd hit intersecting uptrend line plus very good price support. It's about a almost 7% drop from where we're at now, give or take. and that would certainly provide an objective entry, especially if the charts were confirming at the time. In other words, other things besides just the support level being there, things like divergences or overbought readings, stuff like that. And then with a stop below. So that's the thing. When I say objective, only time will tell if it pans out. My long-term target I've maintained for quite a while here is about 173, 174 up there, and quite possibly beyond. If we are in a new bull market, and if we get up there, we'll probably make a run and take out the previous bull market highs. So that's just, let's just say, my intermediate term target right now. And this was a target that was already hit, about 144 right here, and we pulled back. And so plain and simple, it looks to me like this is just a corrective wave in an ongoing bull market. We don't have any buy signals right now. That's the thing. And I've said this for quite a while. You can certainly scale in. You could be, for the last few months, scaling into gold. It's having a, it's been consolidating. It's a downward to mostly sideways consolidation. And I'll show you some levels to watch where we might have the next buy signals. I also want to say before I leave this chart, one thing that stands out to me, and I mentioned this on, I even used it this morning on another time frame, 60-minute time frame on QQQ. But this PPO, especially the signal line, the 9 EMA, I use that because it's the last of the two to cross. It does a darn good job of defining a trend as being bullish or bearish when it's above the zero line. The zero line is this dotted line right here. See the zero value? And you can see when you cross above, I use the white line because it's the last of the two to cross, the signal line, and that helps to minimize whipsaw signals. So from here to here, you had a little whips. Yeah, no, well, that's where it crossed. So if you want to use the signal pure, let's just say right about here it crossed over. And so it told you through this whole time, you're in a bull market, stay long. It crossed right there, and you can see we'd already started the bear market technically because the top was right here. It wasn't clear yet. Really, it was a big break of this level that kind of really kicked off the selling right there. That was a big support level. That's also why I have that now as a resistance level. But you can see, other than this little whipsaw right here, this entire time said bear market. The trend is bearish. That PPO line was below the zero line, and you can see it would have kept you either short gold or out of it from a long perspective, and you would have avoided a lot of losses and a lot of pain and a lot more, because as I like to say, the miners are simply a leveraged trade on gold because of their business model. When the price of gold goes up, their profit margins go a lot more. So if gold rallies 20%, you'll usually see the miners rally 40, 50% or more. There's not a set formula to that, but it is you have more bang for your buck, and it cuts both ways. Gold drops 10, 15, 20, 30, 40% or 50, the miners are going to drop more than that. All right, so there it is. Pretty effective trend indicator. Yeah, a little bit whippy. No trend indicator is perfect. There were two whipsaw signals in this bull market, and it wasn't, again, it's not a clear, it wasn't a powerful impulsive bull market like this one, like I showed you. It's a series of higher lows and higher highs. So by that metric, it is a bull market. It is an uptrend. But again, it was very much a sideways grind. From this point here, we didn't take out that first reaction high until just recently. This one didn't do it. And so where I'm going with this is when you're using trend indicators, whether they're moving average pairs, whether they're, in this case, the PPO signal line, you're more likely to get whipsaw signals during sideways consolidations. They work great in clear trends like this, not so great here. And again, it's just one of many things that I factor into my analysis. I would never trade exclusively on this, although I'll tell you, you can go back and do the math on it. If you went long and short and got caught in these whipsaw signals every time that white line crossed, I think you would come out to come to the conclusion that you would have made a lot of money on gold and caught the bulk of this bull market, the bulk of this bear market short, and so far the bulk of this bull market long. And where I want to wrap that up is, look, we're solidly right now very much well above the zero line, solidly in bull market territory, excuse me. And again, in a bear market, you don't see that. So this is indicative of bull market action, and that's where we're at right now. RSI, Usually you don't have, most RSIs don't put some do, midpoint at the 50 level. If you had it, it's right here. That also, the 50 level or midpoint on your RSI, you know, it's typically bounded by 70. Well, it's not bounded, but anything 70 or is considered 70 or above is considered overbought. 30 or below is considered oversold. And to just back up to be technically accurate, the RSI is a bounded indicator. It's bounded by 0 at the bottom and 100 at the upside. PPO is not a bounded indicator. There is no limit to where those numbers can go, but that is a bounded indicator. But you don't see 100 reading on the RSI, nor a 0 reading on the or down to the downside when you're oversold. And again, 30 is typically considered oversold, 70 overbought, the red line. But what I was getting at here is that 50 level, it does a good job, just like the PPO 0 line, of defining the trends, and just like the PPO 0 line above, that 50 level or midpoint often acts as support when tested from above when you're in a bullish trend. And so that's what I'm seeing recently, and it acts as resistance when you're in a bearish trend often. You can see some whipsaw, it's not perfect, but if you look how many times that RSI has come up in the bear market, hit on or around that 50 level and stayed below there, or you know, hit the 50 level and stayed above in the bull market, it's pretty impressive. So there it is. That just threw out probably more than enough information or evidence, if you will, that at least as of now, gold's in a bull market. And the problem with long-term charts, I'm going to tell you right now, is that because this is a weekly chart, it takes a while. If gold were to start dropping and go lower and even go below there, it's going to take a while to have these indicators tell you that you're in a bear market, and yeah, you're going to give back a good deal of profits if you are long. And so what you do with that is you move on down to the daily charts, the 60-minute charts. Those are going to get you in and out, give you buy signals and sell signals earlier. But the downside to that, the trade-off is you have a greater chance of whipsaws when you're using the shorter term time frame. In other words, your buy signals, you're going to have a lot more buy signals than on the weekly chart, a lot more sell signals than on the weekly chart, but more of those will prove to be, you know, false signals, or, you know, whipsaw signals. All right, so now we're back down. Now we're on the daily chart, and again, you can see a clear, you know, although the bull market started back several years ago right here in late 2016, late 2015, there it is. There's all the divergent highs, corrections along the way, all the things that kind of, you know, that I'll focus on along the way, and keep that in mind. I'm always looking at different time frames, and so if I'm pointing out positive or bullish divergence on a 60-minute time frame or a daily time frame, you know, the move that you would expect from that, like these divergent highs, these are just corrections within an ongoing bull market, and they're going to be typically commensurate with the scope of the divergence and the time frame that you're on. In other words, if I post a divergent low, a bullish chart pattern on a 60-minute chart, that might be good for a swing trade lasting a few weeks, maybe a couple months. But if I point out or highlight a divergent high or a divergent low on a daily chart, that might be a move, a trend that's going to last several months or more. And so let's just zoom into where we're at right now. The levels to watch. Okay, I told you 130 was a big level on gold. It showed really well on that weekly chart. You can also see it here on the daily as I zoom in and out. So call it 130-ish. There's a gap up. It's at 130.25, and there's that same trend line I showed you on the weekly chart. So again, certainly a possibility. And I would say if the stock market continues to rally throughout December, we close the year higher than we are right now. The market goes on, continues, makes another new high, and holds up into year end and maybe into January, then you'll probably see this. It is not guaranteed, because there are times, and quite a few times, that I've seen gold rally along with the stock market. So we'll just have to, you know, put a higher weighting on what the U.S. dollar is doing, and of course what the charts of gold are saying, than whatever's going on in the stock market. So the levels to watch, again, that would be, it's certainly a potential scenario. More likely, if the stock market continues to rally for the next month or two, we could see a move there, and that would be where I might be very interested in positioning long for the next major leg up in the bull market. Now, We may not drop there. If we do, the level I'm watching, you can see on this chart, is right about the recent lows, 136.5 or so, 136.50. I have a couple reactions there. That's where we've stopped recently. I think if we break those recent lows much below 136, that probably will bring that scenario into play. And again, I measured it out for you. I think I told you it was about a 6% drop. Let me try to grab the measuring tool here. Yeah, 6.5% or so. So really, if it's not that much downside, if you're a long-term investor, you know, you've been accumulating gold or gold mining stocks scaling in. But keep in mind, if gold drops at 6-7% down to there, GDX is probably going to go down as well. Now, let me show you a follow-up with a post I made yesterday, and this is where I started to, you know, put together the video that I'm doing now. A couple inquiries yesterday in the trading room. One of them was on AUY, and what I said here, here's my chart. This is a nice looking chart. This is one of my favorite. I like this one. I like a lot of the individual miners. You can get a lot more bang for your buck by going long the mining stocks with the most bullish chart. You can do a multiple of what gold does. You know, if gold rallies 20% from here, a lot of these stocks will go up 100% or more. I know them because I've traded them for years. And so you want to, you know, you can, if you have the time and inclination to put together a portfolio and be diversified, at least a half dozen names, if not more, the more the better, of the best looking mining stocks. That would be a, you know, I think really some potentially nice, you know, long-term positions, you know, investments or trend trades that could go on, rally for another year or more from here. AUI is one of them. And so my response there was, you can probably see the notes. Just freeze the video. You can read my notes. You know, everything looks constructive. The PPO's in bullish territory, holding above the zero line, and we have this pretty clear consolidation range. Remember, this is not, it's not by coincidence that AUI has been in a sideways consolidation range now for quite a while. That it peaked around when gold did. So gold has been in a consolidation range, GDX has, and so my point was to this is, yes, does it look like it's poised to break out? Absolutely, and it could break out. And yesterday, technically, it did break out. There was an intraday break. However, my reply to that is that breakout has a much, much higher chance of failing, probably will fail if gold doesn't break out soon, especially if gold goes lower. So point being, yeah, well-defined channel where normally I might be all over a breakout, you know, ready, poised to jump into AUI long for a breakout above that level, but I wouldn't take that breakout unless I see supporting evidence on gold. That's the point I was trying to make. And should it fail, probably run back down to the bottom of the channel, especially if gold breaks those recent lows and takes that other 6+% jog down. In fact, AUI could easily come back here. This level looks comparable right here, about, what is that, 278? Here, let me pull a live chart. That was yesterday's chart. And yeah, I'm picking on AUI here, focusing on that one, because the same holds true for most of the miners. And sure, there's going to be exceptions within the gold mining stocks. Some miners that may continue to rally and have been rallying, but you can see it already. That breakout's failed. Why? Because gold's down today. And again, so that's the takeaway from this. I will watch this, and you know, it's a pretty powerful consolidation range, just like gold. You know, when you see a multi-month consolidation like this, consider that effectively the way it works, it's like a coiled spring. The stock is building energy in there. That's usually how these consolidation periods work. And you know, that would be the catalyst for a once we finally get a definitive break to the upside, again, if gold confirms, for the next major leg up, something like this leg up that we had leading into it. And likewise, if it goes the other way, a downside break, especially if gold drops another 6% or so, could easily bring us down here to that 318 support level and then take us down through there to 278. And that's a big move. If you're going to ride that out, you know, if you took AUI long, if you're in it now, or considering taking a breakout, just do the math on what that would mean to you if we fell that far. That's about a 25% drop. I think even the most liberal stops, the most aggressive trader, I think that's going to violate your maximum loss potential there. So food for thought. But strategically, you know, when a stock is in a trading range, I can tell you this, or tactically more so, you know, it's objective. The most objective levels are to go long at the bottom of the trading range. That's long at support, ride it up, and then sell or reverse and go short at the top of the range until you break out. So had I known it would be doing this before, I would have been swing trading AUY. I haven't done it, but you could still do it. But this one's getting long in the tooth, this trading range. Sooner or later, you're going to get an upside break. But again, not until gold chooses a direction. So here's gold. The trading range in gold, it's been over the same time period, but it's been more of it's a downward to slightly sideways range. There it is, right, like that. And again, I could draw a trend line like I just did there with that arrow line. It's not a super well-defined trend line, but it could do the trick. So here's what you want to watch for gold. You want to see a breakout. You want to see it impulsive. Again, I'm not putting a very high weighting on that trend line, so if it does get taken out, the next bullish technical event would be to break out above these recent reaction highs right here, then that one, and then that one. That should put gold off to the races. If it breaks above the recent highs from back in late August right here, we most likely will be already en route on the next, or in the next uptrend should be in play at that point in time. And again, then at that point, I go away from the daily chart, I go back to my weekly chart, and I look at this target right up here, that 173.87. That level is also, I pointed this out recently, gold seems to be flagging here, bull flag on the weekly chart. There's your flagpole right there, and that would be, measured target. I'm just rough estimating it, the distance of the flagpole added to the bottom of the flag, and that should take us up somewhere there. But again, that's where my target's a little bit above that. So the potential is there, but and you can go long gold here if you want to. I just don't have an objective entry. I can't make a strong case to buy it. It might be dead money for a while. You may get stopped out, or it may continue to rally. So I just showed you levels to watch on the daily chart that could trigger that rally. And now let's roll into you'll probably get the question, hey, what about silver? Silver will follow. Sometimes it'll lag behind, and back here I mentioned that it was poised to play a game of catch-up. I mentioned having a preference to a lot of the silver mining stocks, and we even added that as an active trade. Might even still be active. I don't have to check that. And they did. Both silver and the silver mining stocks vastly outperformed gold and the gold mining stocks, because gold got ahead of itself. Silver didn't participate, and there's things called a gold to silver ratio. When that gets out of whack, you get a mean reversion of the two. So we'll be looking for that. But as of now, I'm looking at this chart. I don't see any reason to step in and buy silver here, so I don't want to spend a lot on it. Story is the same. It's been in a bull market. This one it also bottomed back in late 2015, but if you see, I put the crosshairs there, and I'm on SLV, by the way, guys, silver ETF. I know I'm talking fast. That is, roughly an equal low right there. So there, let me box it in right there. Late 2015. Late 2018, it's been walking higher, but silver's, for the most part, it's been grinding around for years now in this range. So the bear market appears to be over, but it's in a more of a sideways market, and it has not. Unlike gold, it did not take out that 2016 reaction high yet. However, if that bullish scenario in gold plays out, most certainly I think silver will, and you can see my target zone up here, near-term target zone. That would represent a rally of anywhere from about 52 to 62% from current levels in SLV silver. Okay, and to wrap it up, we'll look at the currencies, because again, as I said in the beginning of the video, if you want to, I like to look at the US dollar to help either confirm my analysis on gold or refute it. If I'm seeing something, let's say I see a bullish setup on gold, but then all of a sudden I also see a bullish setup on the dollar, well, yeah, gold can rally if the dollar rallies, but that's going to give it a headwind. And if you're wondering why that correlation exists, it's plain and simple. Most gold around the world, not all, but most gold, and the gold most certainly we trade here in the U.S. If you trade the ETF GLD, which is one of the largest in the world, that's priced in U.S. dollars. So it's simple. If the U.S. dollar drops 10% in value, it depreciates, it takes more dollars to buy an ounce of gold, hence the price of gold goes up. Likewise, if the U.S. dollar appreciates 10%, it's going to take fewer dollars to buy an ounce of gold, so therefore the price will go down. All right, from a technical perspective, you can see the major trends in the last few years. I'm using UUP here, the dollar index. There's a strong bull market, almost parabolic, a very steep advance. You had a sharp correction afterwards, but then you had this primary bull market uptrend line, big divergent high. You can see the negative divergence. Same things that work on stocks and ETFs and commodities. These divergences, you can see I had a divergent low right here at the start of this bull market and the end of that bear market in the dollar. Right here, I had negative divergence, big multi-year negative divergence. This is a weekly chart we're on. Right here, I had positive divergence at the low right there, bullish divergence, and you can see it down here. And that was a catalyst for this bull market. And where we're at now, we've come full circle. Wash, rinse, repeat. And so, although divergences are, like I said, they're not sell signals, they're merely an indication that an impending trend change is likely. And we've had these divergences just like the stock market. These divergences have been building. And just like the stock market, it's not by coincidence too, it's going up. We're the best of breed right now around the world, U.S. economy, U.S. stock market, so our dollar's strong. Because our economy is strong, we have higher rates, relative to most other countries. A lot of European countries still at negative rates. We're not at negative rates. We didn't go to negative rates, hence a strong dollar. So, but everything works in cycles. Nothing goes up forever. And you can see I had a trend line here on the U.S. dollar or UUP that broke. We back tested it for a while. We set up in a minor trend line, secondary trend line, broke that one as well. And then we set up, that was the top back here, by the way, on October 4th. Then we set up on this rising wedge pattern, and that recently broke down. And so these are sell signals. We're not seeing any really impulsive selling yet in the dollar, but I'm watching that. And when I look at this chart, this tells me, again, just my read on the chart, whether I'm right or wrong, that the bull market in the dollar is most likely close to being over. And when it is over, when we have that proof, these divergences say we're not just going to have a little correction, we're going to have a major trend reversal. In other words, a bear market in the dollar, a major drop in the dollar that would last most likely a year or more. You can see the time. Look at the scaling down here. These are years 2017, 2018, 2019. So remember, it's a weekly chart. All right, so that's the longer term outlook for the dollar based on the weekly chart. Near term, when I look at UUP, here's that same wedge right here. This chart's busy. Let me do this. Let me flip this upside down and show you. Although that is a level to watch. Let me highlight. You can see this trend line right here. Break that. Here's support right here on UUP about 26.44. But one of my favorite proxies for tracking the dollar is a euro-US dollar pair, because the euro is by far, without even a close second, the largest component of the US dollar index. Going from memory, I think it's 60, drawing a blank, 60-something%, and then the yen is second, well below that, and every other currency in the dollar index just doesn't even move the needle. And you can do that. You can do it yourself if you mirror the euro-US dollar pair. Overlay the euro or US dollar. I'm sorry, it's going to be an inverse and a very close relationship. So what do I see here? There's a lot of trend lines here, but we had these trend lines which were broken right here, back tested. We put in a divergent low right here. We've been building these positive divergences for quite a while now. Even the weekly chart. Remember, this is just like flipping UUP upside down, because when you look at the euro-US dollar, it's showing you the euro against the dollar. So if this chart rallies, if this currency pair rallies, that's a euro going up against the dollar, meaning the dollar's dropping. And you can see the same thing. We have positive, big, strong, about a year-long bullish divergence building here, just like we had here at this divergent low before that major uptrend in the euro-US dollar pair, just like we had negative divergence at the high, which was the catalyst for this drop. So I have a pretty high degree of confidence that this will play out for a major trend reversal, and looks to me quite likely the bottom's already in. We'll see. Let me zoom down to the daily chart. So what we need to do, we broke out of this downtrend line recently. We came up, and for quite a while I've had this secondary trend line right here, this blue trend line off the highs in late 2018, and we hit it. That was a target way back here. We hit it again. We failed at it twice. We're testing it again. It looks to me like the euro wants to punch up now. As I like to say, resistance is resistance until and unless taken out. So you need to take this trend line out with conviction. You need to take out 111, 1118. That's pretty decent resistance level there. But if we do, I think you know, the euro has should run from there. Next resistance would be here about 111.18 or so. Yeah, somewhere around there. And here's that Euro futures chart I've been trading lately. E7, the Euro futures. There's your bullish divergence. We had bullish divergence right here recently. Nice lift up there. This is a big level, 111.09 right there. We tried to pop it today and failed. You can see a little brief pop, but we couldn't close above there, especially on the 60-minute. This is a 60-minute chart, so you need to see a 60-minute close. But you can see a lot of reactions around that level. Going back in recent weeks here, last couple months. And so therefore, if we can pop there, that should open the door, I would think, for a move all the way up here to about that, at least at 112. But remember, this is just a 60-minute chart. If that happens and we get that, that should open the door for, you know, a breakout on that daily chart, that trend line I told you about. So there's what I'm looking at. Those are the levels to watch. And you know, at the end of the day, I'm not going to pour over the charts. I will do it in a separate video when I really start to warm up to gold and GDX. And what I'll do is a video covering my favorite mining stocks, or I'll post some individual charts. I did that with the silver mining stocks before they took off. I highlighted my 4 favorites, and all of those I think were up, if not triple digits, you know, 100% or more. They were well into the double digits from that post. So we'll wrap it up here. Let you know I'm keeping an eye on this. There's just a little more work to be done. We've been consolidating for quite a while, and just a little more work to the upside on the euro, a little more downside in the dollar. Could start, you know, an accelerated trend in both, and that should be bullish in gold. We'll watch the stock market and everything else as well. Obviously, a correction in the stock market, especially a sharp one, should give gold a flight to safety bid. So, you know, I may jump on gold quickly in some gold stocks. You know, that could happen any day now. Don't become complacent. The market's been grinding higher, and it's been extremely resilient. It's showing some cracks recently, but, you know, not enough to write it off yet. So I just want to let you know that, you know, things can change on a dime, and if that happens, I will get out some trade ideas in the individual mining stocks, and as well as GDX for those of you that prefer the ETFs, or GDXJ, SILJ, SIL. Those are the silver mining ETFs. I'm going to wrap it up here, guys. Get this video out to you, and let me know if you have any questions.